Is the golden glow fading? Unraveling the future of gold prices. The recent dip in gold prices has investors wondering, is this a temporary stumble, or a sign of a longer decline? But here's where it gets intriguing. Despite the drop, analysts like Praveen Singh, senior fundamental research analyst at Mirae Asset Sharekhan, suggest that buying on dips could be a smart strategy. Why? Because the possibility of December rate cuts by the Federal Reserve remains on the table, and gold continues to find support from various global factors. Let's dive deeper into the dynamics shaping the precious metals outlook. Gold's roller coaster ride, a week of ups and downs. In the week ending November 14th, spot gold experienced a dramatic swing. After surging to $4,245 on November 13th due to inflation concerns, sparked by U.S. Treasury Secretary Bessent's remarks about potential $2,000 tariff rebate checks, gold plummeted 2.64% in the final 2 trading days. This drop was fueled by uncertainty over a December Fed rate cut, as several Fed officials voiced opposition. The U.S. government shutdown further muddied the waters, intensifying market jitters. At the time of writing, gold was trading at $4,080, down 0.1% for the day, while the MCX December gold contract dipped 0.44% to 123,022 rupees. Global data, mixed signals for gold. Economic data has been a key driver of gold's volatility. U.S. Empire manufacturing for November surprised on the upside, hitting 18.70, its highest since November, versus an estimate of 5.80. Construction spending also beat expectations. However, China's data painted a gloomier picture. While retail sales rose 2.9%, industrial production and fixed asset investment fell short of forecasts, reflecting ongoing challenges in the world's second-largest economy. Even China's credit expansion in October was the weakest in over a year. And this is the part most people miss. Weaker Chinese data often boosts gold's appeal as a safe haven asset. Dollar strength and yields, a double-edged sword. The U.S. dollar index, a key gold antagonist, was trading around 99.45, up 0.15% for the day. Meanwhile, 2-year U.S. yields held steady at 4.61%, while 10-year yields dipped to 4.12%. These movements reflect investor caution ahead of a deluge of U.S. economic data, including ADP employment, industrial production, and housing starts. The Fed's October meeting minutes and September non-farm payroll report will be closely watched for clues on monetary policy. Gold ETFs and COMEX inventory, a tale of support. Global gold ETF holdings stood at 97.39 million ounces, MOs, as of November 14th, up 0.15 MOs for the week but down from the October peak of 98.94 MOs. Despite this, holdings are up 17.54% year-to-date, nearing a 3-year high. COMEX gold-eligible inventory, however, has fallen 2% from its April peak to 17.90 MOs, as investors take physical delivery amid tariff volatility. These trends underscore gold's enduring appeal as a store of value. Fed speak, the rate cut debate heats up. Federal Reserve officials have been vocal about their concerns. Vice Chair Philip Jefferson highlighted downside risks to employment, but warned against a December rate cut, citing neutral interest rates. Other Fed presidents, including Schmid, Hammack, and Newslam, echoed similar sentiments, pointing to persistent inflation. Mary Daly of the San Francisco Fed urged patience, while Minneapolis Fed President Kashkari deemed current inflation too high. Here's the controversial question: are Fed officials overestimating inflation risks, or is a December rate cut truly off the table? Share your thoughts in the comments. Geopolitical tensions, a golden linchpin. Escalating China-Japan tensions over Taiwan have added another layer of uncertainty. Japan's PM Sanai Takaichi's remarks about potential military involvement in a Taiwan conflict have kept markets on edge. Meanwhile, Taiwan's distribution of civil defense handbooks underscores the island's preparedness for a potential Chinese attack. Such geopolitical risks often bolster gold's safe haven status. Silver's shine, a parallel story. Silver, often overshadowed by gold, has shown resilience. In the week ending November 14th, the gray metal tested resistance at $55 before retreating nearly 7% on rate cut uncertainty. Despite this, it closed the week up 4.67% at $50.58. At the time of writing, spot silver was trading at $50.91, up 0.6% for the day. Global silver ETF holdings surged by 6 ms last week, a positive sign for the metal. Improved risk appetite, driven by encouraging tech earnings, could further support silver prices. Outlook: navigating the golden maze. Gold's future hinges on several factors: China-Japan tensions, U.S. tech earnings, and the September non-farm payroll report. While the probability of a December rate cut has dropped sharply from 63% to 41%, it's not entirely off the table. Gold is expected to trade in a range ahead of these key events, with support at $4.050/$4.000/$3.936 and resistance at $4.160/$4.200/$4.260. For silver, dip buying remains the preferred strategy unless gold or risk assets plummet. Final thoughts: a golden opportunity or a fool's errand? As markets grapple with uncertainty, gold and silver continue to offer a hedge against volatility. But with conflicting signals from economic data, Fed officials, and geopolitical tensions, the path forward is far from clear. What's your take? Do you see gold prices rebounding, or is the downturn here to stay? Let us know in the comments below. Disclaimer: the views and recommendations expressed in this article are those of the experts, and do not necessarily reflect the opinions of the Times of India. Always conduct thorough research or consult a financial advisor before making investment decisions.